What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. In today's episode, I'm joined by Althea Spinozzi, also known as the Bond Girl. She's the head of fixed income strategy at Saxo Bank and a well-renowned industry expert on the bond market. We'll discuss the current interest rate environment and its impact on U.S. equities, what Althea's projection is for inflation and rate cuts this year, the risk reward for buying treasuries or bonds right now, and how she anticipates the rate environment for the remainder of 2024. Let's get started. Today's podcast is sponsored by TradeStation. Serious futures traders, level up your skills with TradeStation's powerful platform. Enjoy flexibility, superior trading power, and save big with 50% off brokerage fees for the life of your account. Open a new futures account today at TradeStation.com/Anthony, and you'll also get 10% intraday margin rates on 3 popular futures markets. Discover why TradeStation is my go-to platform for trading options on futures. Explore the robust platform now at TradeStation.com/Anthony. Althea, welcome to the show.
Hello, Anthony. Thank you very much for having me here.
Oh, it's great to have you here. Of course, I found you on Twitter and became a big fan of your channel, The Bond Girl. I love the nickname. I know, obviously, there's a little James Bond plus, obviously, bond market in there. How did you get that nickname?
It's just that it's hard to find the girls in the bond market, right? It's more like a male-driven sector. And I think that it's important to have a little bit of fun while working. So why not the Bond Girl?
That's right. I look for channels on Twitter, on X, that, I mean, obviously there's a lot of smart people out there, but I like to find the channels that can explain stuff to us that we could actually use as traders and investors. There's obviously so many people out there that just want to sound smart on X, but you do an absolutely fantastic job of explaining the bond market in a way. And look, I've been in this business for 25 years. Even someone like myself, I'm not a bond trader. I need someone to explain it the way that you do. I really do appreciate that.
Thank you very much. Can I call you Tony?
Of course. Yeah. I mean, look, this could be the best looking podcast I'm going to do all year, everybody. If you're listening to this on audio, you've got, we were just talking about this beforehand. We got the American Italian in here and we got the real Italian in here. And Althea and I were talking about how in Bari, where my grandparents are from, how they're still making pasta on the street. They take it inside after they're making it fresh, make it, and then bring it right out. Is that right, Althea?
Absolutely. You have to go. Everybody should go to Italy.
Absolutely. Let's dig into today some of the things that we're going to discuss. We talked about the complexities of the bond market, and I think that for many equity traders, majority of the traders, the day traders out there, the swing traders, the investors are mostly looking at stocks. They're not necessarily looking at bonds. You obviously have the sophisticated ones that are. But how do you navigate the complexities of the bond market, particularly for investors who may be new to this asset class?
Well, I believe that when one approaches the bond market, I should start to talk about cost of funding. So what's my benchmark, government benchmark? And hence, we are talking about U.S. treasuries. And really, your government benchmark is going to drive a cost of funding for virtually everything. Mortgages, corporate bonds, and the higher it gets, the more challenging the business environment is going to become. So I think that today that we are coming from bull stock market with the Standard & Poor growing 25% in 2023, and yields also growing, rising to the highest that we have seen since before the global financial crisis, is setting up a very interesting macroeconomic environment, and bonds are gaining a lot of spotlight because for the first time in many, many years, they are providing an alternative. And I know, Tony, what they're going to tell me, US treasuries at let's say 10 years the US Treasury is at 4.2% or even 3 months T bills at 5.3%. They cannot beat the stock market that is rising 25% and the Nasdaq 50% in 1 year. Yes, it's right, but what really bonds are providing right now is some sort of diversification. So if you have a stock portfolio and you're starting to believe that the growth you have seen in the past couple of years is not sustainable long term, and there is the risk that something might break, well, bonds are a great instrument to add to one portfolio, because if it's true that they lose if yields continue to rise, but we have central banks now telling us that they shouldn't because they are preparing to cut rates, not to hike them. And if they drop, they can definitely boost your returns. And normally I make this example, the 10-year US Treasury example, just to understand the risk and reward ratio that these instruments are providing right now. So if you buy today 10-year US Treasuries at 4.2%, and you expect to hold them for 1 year, if within this time frame yields rise to 5.2%, you're going to lose more or less 3%. But if yields drop to 3.3% because there is a downturn, like we said before, well, you're going to make 12%. So does it make sense to have the risk to lose 3% in a diversified portfolio if you believe that something might change in the foreseeable future? I believe that it makes sense. Obviously, this kind of risk reward ratio changes according to the tenor we are looking at. So the 10 years is going to provide some sort of benefit, but the 30 years is going to be much more risky than, for example, the 2 years, which is almost basically a win-win scenario. It's almost impossible right now to lose money in the 2 years.
A couple of things. First, I want to stay on that real quick. Thank you so much for that explanation of the 10-year, that 3% possible risk versus a 12% gain, especially right now in a market that's potentially looking at what, 3 cuts, and it went from 6 to 3. I mean, the bottom line is looking forward, whether we're going to get to this, I'm sure, of course, at some point, Althea, whether we think it's 3 or less or more from your perspective. But in this environment, that's a great risk reward for any trader or investor. 3% risk to make 12% all day long. You take that, especially if you've had some runs in some of these tech stocks. Why not allocate some of those gains there? But I want you to just quickly go over why the 2-year yield versus the 30-year yield. The difference, obviously, is because of the volatility within those bonds or treasuries. Why you say there's almost no risk in the 2-year, but there's greater risk in the 30-year.
Well, the 2-year US Treasury yield is an expression of monetary policies. So basically, it's pretty much linked to the expectations of what the Federal Reserve is going to do in the foreseeable future. And that's why the front part of the yield curve has risen accordingly in the past couple of years, because the Federal Reserve was hiking and the 2 years was following. The 10 years instead was rising at a slower pace, because as the Federal Reserve was hiking, investors grew more anxious that something might break on the way. So they were better buying the 10 years, where they were staying there in a sort of protection. And that's why the yield curve started to bear flatten. So basically, short-term yields rose faster than long-term yields. The reason why I say that in the 2 years is almost impossible to lose money is that you need the Federal Reserve to continue to hike rates aggressively. And now that inflation is much lower than where it was 1 year ago, it's true that there is always the risk of the Federal Reserve to deliver another hike, but it would need to deliver 3 or 4 hikes in order to make sense in the 2 years. So when we do that risk reward kind of analysis on the 2 years, you see everything green, in the meaning that you assume to buy today 2-year US treasuries at 5.3%. If that yield goes up by 200 basis points, so we are talking 7.3%, you would start to lose money there. But if the yield drops 100 basis points, you will make around 5.5, a little bit more, right? But not as much as, for example, as the 10 years. So really, if you are in the 2 years, it's almost like parking money at this point of time, if waiting for better opportunities. It's different when we do this kind of risk and reward analysis, when we look at ultra long government bonds. So, for example, the 30 years, because at that point, it's a much more directional bet on how fast the Federal Reserve is going to cut rates. So if you have yields rising by 100 basis points, you're going to lose 17%. But if yields in the 30 years tenor are going to drop by 100 basis points, well, you're going to make more or less 20%. But obviously, it's more skewed, this kind of bet, than, for example, the 10 years or even the 2 years, where there is virtually almost no risk that we are going to see 2-year US treasuries at 7%. At least it doesn't seem so right now.
Thank you so much for explaining that. Quickly, before we move on, I'm sure some people out there probably don't understand the difference between a treasury and a bond. Can you just quickly explain to them what the difference is between the two?
So US treasuries can be notes, bonds, and bills. So the name bills refers to bonds up to 2 years maturity, below 2 years maturities. Notes are normally between 2 years and 10 years in tenor, and instead bonds are whatever from 10 years up. So the 10 years can be notes or bonds. And US treasuries, I'm just referring to the government bonds or notes that are issued by the US Treasury in the United States.
Yep, that's why when you look at the futures markets, everybody, it says 10-year treasury, 30-year bonds. And I know there's so much conversation out there. Some people will say bonds or treasuries and they kind of commingle them. But thank you so much, Althea, for explaining the difference between them. How much of this current rally is a byproduct of the projected rate cuts?
Are you referring to the bond rally that we have seen since November until recently?
Let's talk about the equities first.
I think it's a little bit of a mix. You see, it's not only stocks that are going up. A lot of my job is to look to turn every stone to see if there is some pockets of distress or opportunities out there. And every stone I've been turning as of recently has shown me that there is no stress, that everything is happy-go-lucky. So the biggest example is the corporate bond market. Corporate bond spreads have tightened to the most since pre-COVID. It means that if you buy corporate bond, it can be high yield or investment grade. Today, you are going to be paid over US treasuries more or less what you were going to be paid before pre-COVID. And this is despite the Fed fund rate went more than double within that same period of time. Obviously, Anthony, when we talk about spread, because I'm not sure if everybody is comfortable with this terminology, what we are talking about is about that pickup that a corporate bond is paying over the US Treasuries. So basically, I'm taking an investment grade bond that right now on average is paying around 5%, minus a US Treasury, which is around 4.3%. That spread is telling me how much I get paid over US Treasuries. But of course, if I look at the absolute yield level that these securities are paying me today, they pay me much more than what we have seen since the global financial crisis until today. So investment grade around 5% and high yield bonds around 8%. So it looks appealing on a surface, But when I look at the level of distress, I can see that the absolute amount I'm paid over the risk-free rate is at a minimum. And in my word, it means that something that these kind of spreads should widen, and it's better to buy the sovereign rather than the corporate bond at this point in time.
I have been seeing some tweets, posts, now we call them on X, talking about how this is the tightest corporate bond spreads have been since 2008. Anytime someone brings up 2008 comparisons, you don't know if it's whether it's clickbait or if it's something that really matters. Does this matter?
I think it matters in a way that it has been a very long time. 15 years is a very long time for us to get used to a different kind of financing environment. And that's true for not only the corporate bond market, but also loans, mortgages, and so forth. So the big problem that we have right now is that how long can we survive at these yields and rates level? Because at a certain point, everybody is going to be to refinance. So, Anthony, I think that it's very good to highlight that right now we didn't have much distress or much negative news coming from the corporate bond market or also loan market, for the simple reason that we didn't have much maturities yet. They are going to pick up in the second half of this year and from January 2025 forward. So if a company doesn't need to get refinanced at high rates, it can just wait unless it's really cash strapped and really needs to raise money today. And that can obviously be a danger for that corporation, because at that point, then investors would need to open up the balance sheet and understand if they want to invest in that corporate. And they might demand a higher yield than what the market is pricing currently. And that's why everybody is just trying to wait out. The Federal Reserve is telling us that is going to cut rates, and everybody assumes that that's going to be positive at a certain point in September or December this year. But the big problem that I see is that the yield curve, the normalization of the yield curve from inversion to a steeper kind of curve might imply that the long end is going to rise and not drop at this point in time, depending on where inflation is going to stabilize. If inflation is going to move to 2%, then it's going to be positive for everything out there, the stock market included. If inflation is not going towards 2%, then the Federal Reserve has to be slower at cutting rates, and the long part of the yield curve might rise further, because bond investors, I'm sure that everybody heard the word bond vigilantes. Who are these bond vigilantes that sometimes come in the market and they demand more premium? Well, they are just the simple investors that they say these, that they look at the fair value of a certain asset. It can be the 10-year US treasuries or the corporate bonds. And they say, like, no, for me to buy this thing, I need to have a higher return because it carries much higher risk. And the problem is that one, that if there is a hiccup along the way, we can have bond vigilantes asking for a higher return premium, exactly as it happened in the last quarter of 2023, when the term premium moved above zero for the first time in I don't know how many years. I think it was around a decade. But now it's again below zero. So it's telling us that they are sleeping, but they're there.
Yeah, that really helps, I think, a lot for the traders that are looking at equities. And it tells me as a trader, as an investor, I really have to keep an eye on the 30-year bond market when we get data points on inflation, because if those rates start to go up quickly, that's going to have a significant impact on the overall stock market. Am I right, Althea?
Absolutely. It depends which stocks are you looking at
Yeah.
as well, in the meaning that there is tech stocks are very famous to be exposed to the very long part of the yield curve, for example. But there is other kind of sectors that instead are normally financed in the mid part of the yield curve between 5 to 10 years. But Anthony, this conversation that we are having regarding inflation and the possibility of yields in the long part of the yield curve rising, it's including also the 10 years, because obviously 10-year yields now are at 4.2%. We see them rising to 5%. And I don't exclude that we might see them rising again to 5%. And there is a three reason for that. The first reason is that what we talked about, inflation is just can be sticky, or it might not drop to the 2% target of the Federal Reserve, and therefore the Federal Reserve cannot cut rates accordingly. The second reason is that that's the worst scenario, that the market doesn't believe that inflation is under control and the Federal Reserve is going to cut within this time frame, and therefore bond vigilantes are going to ask for a higher risk premium because they say inflation is not a done deal. I need to be compensated for that risk at this point of time. And the third reason is that the US Treasury is preparing to issue an avalanche of US Treasuries in the second quarter of the year. The US fiscal deficit is just massive. And according to the latest quarterly refunding and the Treasury Borrowing Advisory Committee report, it seems that the US Treasury might issue more than $1 trillion worth in coupon issuance. And already by now, Anthony, as we speak, in February, we had a 10-year US Treasury auction that was the largest size ever, even above pandemic levels. It was around 42 billion. So it shows you that this supply-demand problem is not really over. It's here to stay. And is just enough for one of these things to not to fall into place for the 10 years to rise. So we might see again the 5 years yield.
Yeah, I know. I got you. And so, yeah, seeing that 5%, it's interesting hearing you talk about this from the perspective of there's might just be too much supply and not enough demand at these rates. And that's what will potentially drive us to a 5%. You can even see it in the 10-year tape. I day trade it and swing trade the 10-year a lot. I mean, they cannot catch a rally and hold a rally. It just keeps continuing to drift lower this year. And as traders, we continue to say, is the market ever going to actually look at this and notice this? Because you can see rates continually are chipping higher. A couple of things I want to talk about. First is we've got some inflation data coming up, PCE this week. Where do you see inflation going forward from here?
Well, we as a bank, we are at consensus, market consensus. So we believe that inflation will continue to decrease throughout the year. And eventually in 2025, we are going to hit the 2% target. But we also recognize that inflationary pressures this time around are like we haven't seen any time before. And on the top of that, we have some geopolitical complications that are putting us in motion a series of events that might put further pressure on inflation. So really, when we look at the 10-year US Treasury, we recognize that it can move in a range between close to 3% up to 5%. And the reason for that is very, very easy. So when we look at the dot plot, we see that the Federal Reserve is telling us that the long-term neutral rate is at 2.5%. So whenever the market reads faster than expected these inflationary forces, or like it fears there is going to be a downturn, the 10-year yields is trying to reach and price according to that long-term neutral rate that has been provided by the Federal Reserve. And it's normal to see US Treasuries fluctuate back and forth. And when instead I look at the 5% mark, what I have to keep in mind is what market expects the long-term neutral rate to be. And right now, the bond futures market are telling me that the Fed fund rate might not drop below 3.5% for the next 10 years. And if that's true, then I have to price the 10 years accordingly. And how do I price that? Well, I'm going to have a steeper yield curve. So the 10 years should price, within 100 and 150 basis points over the Fed fund rate. And that is giving me a fair value on the 10 years between 4.5% and 5%. So this is the kind of range we are looking at. However, it's impossible for us to tell now whether there is going to be a rebound of inflation because we are not there yet. But it's safe to assume that maybe the fight against inflation is not as straightforward as the market wants to believe, because we have unemployment still very low. We have wages growing above trends, and the economy overall remains resilient.
So markets anticipating 3 rate cuts this year. What are you guys anticipating?
We believe that it's more or less right. What the market doesn't really price is the expectations of quantitative tightening. And already last week, with the release of the FOMC minutes, we saw that the Federal Reserve members are going to look at quantitative tightening in depth as soon as March. And that's going to be very important because right now, quantitative tightening is putting a strain on financing conditions as much as the level at which the Fed fund rate is set. So in the past hiking cycle, we estimate that the quantitative tightening has served as a couple of rate cuts. And we believe that also this year and in the foreseeable futures, the tapering of quantitative tightening or the end of quantitative tightening can substitute some of those rate cuts. I expect quantitative tightening to be tapered as soon as March, not because there is the need to do that, but because the Federal Reserve has advertised very well the intention to do something with quantitative tightening and also the intentions to cut interest rates. And Tony, when did the Federal Reserve hinted to such intentions? In December, when the GDP, or the quarterly GDP in the United States, was growing above trend for 5 quarters in a row, and inflation was above 3%. So I believe that the Federal Reserve right now, this year, is not looking at inflation like it was looking at in 2023. Is looking at the soft landing. And the soft landing needs to be reached at all costs, because in September we have an election. And we can stay here and debate about how apolitical the Federal Reserve is. But the Federal Reserve is formed by people that vote at the elections. And the election constitutes a macroeconomic event per se that needs to be protected from volatility, because if there is volatility coming to elections, then that can influence the outcome of those elections. And that's why the Federal Reserve will taper quantitative tightening, because they don't know very well where the level of ample reserve is. So they want to arrive there very slowly. Now there is ample reserves. We have between the reverse repo facility and bank reserves, we are over $4 trillion, which that's very ample. But they want to ease somehow the stress that is applied in the money market sector, especially in light of the BTFP program that is going to end in March. And they are going to deliver a rate cut, because when you look at real interest rates, real rates are the highest we have seen since 2008 until today. So they are afraid something is going to break, and they don't want it to break in the summer period just before the US election. If that is going to be a good decision or not, we will know only by the end of the year when we have the report on inflationary pressures, because it takes time, obviously, for rate cuts to basically filtering into economy and maybe provoke another rebound of inflation. But there is that risk.
If I take everything in that you're talking about today, a couple things come to my mind. First, we talk about the supply demand with bonds and how that in the short term is pushing yields higher, in the 10-year. Then we talk about the Federal Reserve, who's not supposed to be politically driven at all, is actually going to be cutting rates when the market is signaling something else. It sounds to me that the market's saying, don't be in a hurry to cut. It's not ready yet, but they're going to do it anyway because they're trying to squeeze in a soft landing as best they can, or at least appear it to be that way heading into an election.
This is my personal opinion, but
Yeah.
obviously it all comes down to the timing, right? Why did they
Yeah.
announce it in December? In December they were nowhere near to a soft landing or to any kind of landing than where they are today. So it makes sense also, like in terms of schedule, right? Tapering of quantitative tightening in March, then a rate cut in June, another one in September, and then December, once every quarter. And that's going to be slower than, for example, the market is expecting. But, I have actually a chart with me, but I didn't open up my my Excel. But I have a chart that basically shows what stagflation, like stagflation in the 70s until today, and the 10-year US treasuries. And basically, the way that we measure stagflation is with unemployment plus inflation minus growth. And what that line is telling us is that the more the stagflationary environment, the higher US treasuries are going to rise. And the reason is that when you look at nominal bonds, they are a reflection of the nominal growth of a country, which includes inflation. So right now, the 10-year US Treasury is telling me that we are heading towards a soft landing because it assumes growth around 2%, so a trend, plus the break even is around 2.2, 2.3%. So basically, it's telling me that we are getting very close to 2%, and that's a soft landing. But what if that doesn't happen? What if something else changes? What if investors ask for a higher return premium? Then definitely we can go up to 5%. But still, going back to what we said at the beginning of the call, Tony, it makes sense if one is a buy to hold investors holding a stock portfolio. It makes sense that kind of risk reward that the 10 years gives you. If you are instead an active trader that is trading short term, obviously you are going to put everything together. And while the front part of the yield curve, it's done, like the kind of rise in 2-year yields to match the dot plot has already run from the beginning of January until today. There is no more room to play with in that part of the yield curve. What is left, what people are left with is the long part of the yield curve that looks mispriced somehow at this point in time.
So, how might these actions with the Fed cutting rates start to impact sentiment towards treasuries?
Well, it depends where inflation is. So if the Fed cuts rate and inflation is under control and on the way to 2%, it should be bullish for bonds, or at least bonds up to 10 years. The first rate cut can be also bullish for the very long part of the yield curve. But if inflation stays more or less where we see it today, so let's say below 3%, but in the high twos, and it looks like it's stabilizing around that level, then that's bearish for bonds. And also, it can provoke a further bear flattening on the yield curve, because at that point the market will question itself whether another rate hike might happen and the Federal Reserve needs to pivot again.
Boy, it really tells us that we really need to be watching these auctions, right, Althea?
Absolutely. I watch them.
Well, I know
Today
that
we
you
have,
do, but I think a lot more people need to be watching them right now
yeah,
too, because
everybody.
you're going to be having a lot of push and pull between what the Federal Reserve is doing versus what the actual market is willing to accept in terms of rates. And like you said, the supply and demand issue, I find that to be so interesting, and how volatile that could create not only in the treasuries and bond market, but in equities.
Absolutely. But I still think that these kind of the auctions that come from the US Treasury should be absorbed anyhow, somehow. I don't think that is going to be a problem who's going to buy US Treasury, because there is going to be always demand. The real problem is that there might be volatility coming from them. And the biggest example is that last week we had a 20-year US Treasury auction, and it tailed. When an auction tails, it means that the yield, the high yield at the auction, was higher than when issued, than what was traded just before the auction, and is just telling that investors might demand for a higher yield to hold these securities than what the market was pricing just a few seconds before. And normally, when that happens, it can intensify the sell off of US treasuries and the rise in yields. So I'm looking at US treasury auctions because they are telling us very important information, such as, for example, also the demand that comes from you see, like I'm as a European investor, if I want to buy 10-year US treasuries and I have to hedge them against the euro currency with a 3 months euro dollar future, then I'm going to secure around 2.7% in yield, which is around 50 basis points above the 10-year bonds. That's good, yes. But if I look around in Europe to other European sovereigns, well, I can secure up to 4% if I'm willing to buy Italy, for example. Okay, risky, but Spain, it's around 2%. France is around 2.7%. So does it make sense for me to go and buy another a position in another currency, hedge it, when I can do that at home and be more comfortable with my investment?
Yeah, we didn't even get into the ECB or BOE today. I think that we have to have you on later in the year to extend that discussion. I want to end today just talking about the small caps a little bit, because I talk about this a lot. I mean, the Russell at the end of last year had that explosive rally. So much of the Russell 2000 is tied to rates. And this year, you could see that the market's just churning in the Russell 2000, sitting back waiting to see what's going to happen in the rates market. Any thoughts on? I know that you're the bond girl, but I'm just curious what you think about this entire marketplace right now that you're seeing, and how that potentially may have an impact on small caps, Russell 2000.
Small caps normally rely on a shorter time of financing, so up to 5 years on average. And normally they are a high yield bonds. So when we look at their cost of funding, we have to look at the belly of the yield curve and how that behaves. Normally, when there is a steepening or a flattening of the yield curve, the belly is the first one to respond. So it's going to drop faster or rise faster. So it might be that if we have these inflationary trends continuing and the Federal Reserve cutting gradually, that could be positive for the cost of funding that these companies are going to price on, right? Because it's going to lower. The big problem is that if we have that kind of tail scenario, in the meaning inflation not under control, the Federal Reserve pivoting again towards hikes and not cuts, well, that is going to be very negative for this part, because the belly of the yield curve is going to shift higher, and these corporates needs to refinance over that kind of funding. So I honestly believe that right now the chance is, like Tony, people talk about soft landing, hard landing, no landing. But when you really think through all these scenario, even when you have a soft landing means inflation is under control. The Federal Reserve is going to decrease rates, but is not going to cut rates to levels that, for example, we have seen post pre-COVID in 2021, right? Because that would be excessive. That would be like stimulating again the economy and inflation. So they will need to stabilize somewhat higher. Well, it means that anyway, these corporate bonds are going to be somehow stressed for longer, because a lot of the debt that they have been taking in the past since COVID until now, so the last 4 years, has been based on those very low rates. And the longer rates are going to stay high, the more probability is to have some sort of defaults. And when in bond markets we are having the junkiest of junk defaulting, credit spreads react very fast, and everything is going to be very much alerted and widening. So I think that there is going to be volatility in this part of the market for sure, and there is not now, but as we approach that wall of maturities that we were talking about before in the second half of the year, and the biggest wall is in January 2025, that can spell trouble for this sector.
Althea, I can't thank you enough. I've just become such a huge fan of yours. Following you on Twitter not too long ago, it's so great to have you on the podcast. I could listen to you talk all day about the bond market. And like I said, I just think that you're just really fantastic. And everybody out there, you have to follow Althea on Twitter, follow what she's doing everywhere. Althea, where can people learn more about what you're doing? And also just obviously make sure you plug your Twitter channel.
Absolutely. Well, they can follow me on Twitter, obviously. I think that my Twitter name is Althea Spinozzi altogether. It has been a while. I don't check on that one. But also, I publish regularly analysis on saxo.com. We have analysis, me and my colleagues. I'm writing for bonds, and we have also other sections for equities, macro, and so forth. And it's all free, so anybody can access to it.
Yeah, everybody follow Althea on X and check out what she's doing at Saxo Bank. Althea, I can't thank you enough. I look forward to future conversations with you. So insightful today. Like I said, I love the way you explain everything to us. Thank you so much for joining me today on the Futures Radio Show podcast.
Thank you, Tony, for having me, and I'm looking forward to be back.